Hi everyone, I'm here with James Bryce-Lind. He's the founding commercial director for InFact, and InFact are in the credit bureau space, really, and like a really modern sort of real-time credit bureau. And so, James, thanks very much for joining me today. Really appreciate it.
Thanks so much for having me, Chris. Yeah, InFact, or previously known as InFact Systems, we're a Category 1 credit bureau in the UK. So there's 4 Category 1 credit bureaus: Experian, Equifax, TransUnion, and us. We are very much the little guy, but we are out there driving innovation in the bureau market.
So one of the things that I know that you centered your business around is that this whole piece around real time and making sure you're getting these real time feeds. And how much of a problem do you see that, almost like the latency around data updates being within the market? How much of a problem have you coming across when you're talking with customers?
It's incredibly challenging for the lending market, in particularly the latency in credit bureau data. We've heard analogies from some leading credit risk managers across the space saying approximately 20 to 30% of defaults come from events that could have been identified if there was intra-month lending. So that's loan stacking is a traditional label put on that. I think trying to quantify the problem, it's a multi-billion pound missed opportunity across the credit information market and the credit industry as a whole.
Yeah. And is that just because customers, I suppose, spending habits or income changes throughout the month, and that's where the sort of the gap kind of changes? Or do you get that sort of like lag behavior as well in terms of how quickly a record gets updated? So are they, if they're credit seeking, then that puts the firm at risk, or if they're maybe if they've had some sort of improvement, that means they can't then get additional funding? And where does the sort of like the nuance kind of sit in terms of that opportunity to a certain extent?
Yeah, you're bang on there, Chris. The function of credit information is to help financial institutions rate risk. That's at its core. And the better, more accurate data you have, the more accurately you can rate risk. And that's both from for a consumer lender, they have a worse credit profile, so you would be pricing that risk accordingly. Or if a consumer has a better credit risk profile, that you could be pricing it lower. And if you look at that as a function of how it trickles down for lenders, ultimately it's an increase in default rate as well as missed opportunity, which is highly quantifiable. But for a consumer, and one of the primary purposes of our innovation charter is it leads to exclusion. And that's one of the big things that we're focusing on, particularly in our earlier years at InFact, is making sure that we are building solutions that help lenders that are servicing that excluded population, which sits at around 7.1 million people in the UK, or 14% of the adult population, helping them to get access to credit and then build their credit profiles.
Yeah. And is that to a certain extent also a question of detail, the fact that we don't just know enough about this person because we only have lag data, we don't know enough of the detail? I know you've got like an affordability product that's out there as an example, so therefore our risk criteria means we're just going to exclude them because we don't want to take that kind of risk. Whereas if you get into the detail of it and maybe more real time, then you can understand it, and then that more lending becomes affordable within like various risk ratios, those kind of things. Is that how the dynamics works?
Yeah, in a way, affordability and credit risk are two sides of the equation when you're assessing consumer credit risk. From a credit risk perspective, what you're touching around the sides is the concept of a thin file. When a lender will go to a credit bureau, they will say, here's some information on this person, what do you have on them? And the bureau will respond with whatever credit information has been reported into them. For any number of reasons, that is quite inefficient at the moment. And the credit information study from 2023 has highlighted the challenges that the industry is facing there. But when it comes to rating risk based on that consumer, if the bureau isn't returning more than, say, 5 or 7 pieces of credit information for that consumer, they're classified as thin file. And because you don't have the visibility or the whole picture because of the inaccuracies of the bureau credit report, the lender will have to score that as a higher credit risk. And therefore that consumer will get a higher APR. And the lender will have to have a higher debt provisioning as a result of that. So it really does drive inefficiencies in not just the lender's profitability and economic model, but also in access to credit for the consumers, and that's quite tough.
Yeah, yeah. And obviously, one of the things that a lot of creditors have been used, they've looked towards like open banking to try and fill in some of those gaps. And I suppose it was just, what's the benefit of having this real-time credit bureau information versus just going around getting open banking type information, which has got a lot of the line detail as well. And I know you guys have got that as well. But I suppose just the benefit of sort of almost like DIY versus going to a bureau that's got that.
Yeah, we love open banking here. Will Mason and Andy played leading roles in RunPath, and I myself was at Credit Kudos. Those were both leading open banking providers in their time in the market. And there is definitely a role to play for open banking. It gives you one of the clearest pictures of what a consumer is spending. The challenges that we see with open banking is that categorization, coverage, and conversion, the three biggest issues with it. And in that, we think that it has its place in the market, but it's not there at scale. And so when you are using open banking to collect a bank account and then manually reviewing that, it's inefficient, but it's a fantastic way to really get a gauge on that. And that's where I think open banking does fit in with the human powered lending decisioning. But when it comes to velocity of credit applications at scale, that's where your credit reports from bureaus really do come into their own, because it's ultimately a track record of a consumer and how they've been specifically using borrowing and financial products. It avoids the reliance on categorization, which is a really big challenge with open banking. And it's also a lot better with conversion through the application funnel, because you don't have that friction of asking for a bank account, let alone the downstream challenges of needing multiple bank accounts connected these days. The average consumer has over 10 plus financial products. I have 4 bank accounts in the UK, and I've only been here 5 years.
That's one a year, isn't it? Nearly.
Exactly.
I suppose that consolidation of a view of a customer is something that I suppose you can get. That's one of the big things you get with the bureau, don't you, as well? So when you look at your data, do you see any sort of hidden trends or nuances, particularly as you're in the real-time kind of space, versus what you'd see, for example, in the open banking space or in more traditional kind of credit bureaus? What kind of things are you seeing if you look through some of your data and some with your customers? Are there any kind of trends there that you think are stand out that will be different than you'd necessarily expect?
Yeah, there actually are. And it's something quite admirable from the lenders that we're working with. We're seeing an increased interest in multi-bureau reporting across the entire lending market. The benefits of that for the consumers is that every bureau will have better visibility of consumers in their bureau. If I go back to the thin file example that we just spoke about, it would mean that there would be less thin files across the industry, and therefore consumers would get better risk rated and better rates. So it's a really positive trend that we're seeing here, wanting to do multi-bureau reporting. The challenge that then presents to lenders is the need to go through onboarding with traditional bureau reporting and then service that ongoing burden of reporting into multiple bureaus with multiple formats. That's one of the biggest challenges that the Credit Information Market Study highlighted, and something that we see on a day-to-day basis working with our lenders. In getting that feedback, we've made steps toward making it as easy as possible for lenders to switch on multi-bureau reporting by reporting into us at InFact. We've innovated our way to a solution, which is the core of what we do here, with the launch of our Delta platform. Delta is designed to sit at the beginning of a monthly reporting workflow, where a lender will be able to upload a bureau file, whether that's keys or insight or our own file, fact file, and they'll be able to get a load report in real time, assessing the quality and formatting of the data that they're reporting. What that's doing is cutting down the time that lenders need to spend on reporting by half, which then makes multi-bureau reporting more scalable and less of a burden.
And how much are the feeds into each of the bureaus different and different in terms of format and those kind of things? Because I remember from some of my history, the bureau reporting can always be tricky, and it's got to be right, and it's got to be right from a consumer point of view. And if it's not, then you have rework and all sorts of things. So it can be a real sort of challenge for a lot of teams. But how different is it, and how much of a challenge do you see that? Do you sort of see that? Do you hear that when you go back to people?
We do see that as a challenge, and so do the lenders that we have been working with. Part of the reason why we built Delta was to help solve that challenge. To better understand how it's walking through the bureau reporting cycle. So at the end of a 30-day period or a month, a lender will pull out a file from their loan management system and decisioning platforms or data lake and have to format that into a keys or an insight file format, which is a traditional text file. This is ultimately a process of taking modern technical infrastructure and jamming it into an older CSV file or text file. It's quite lossy and complicated, and it leads to a number of issues around quality and formatting. The traditional process is that a lender will then spend time manually going through validating that data and comparing it on a historic basis, making sure that it's as good as it can be, and then reporting that into the bureau. The bureau will then, and say that's getting put in at day 35. The bureau will then assess that and provide a load report in 5 to 10 days. So we're now at day 40 to 45. The lender or the credit risk manager will then have to context switch away from what they're trying to do, back to the load report, fix the file, and then resubmit it. And that resubmission process and conversation around the errors normally happens over email or phone, which means that the bureau and the lender are discussing PII over, not going to say the most secure means. And so what Delta does is it mitigates the risk and the time, and it reduces the time spent on that post-reporting workflows, saving the credit risk manager the need for context switching away from their real job, and reducing the flow of PII across less secure channels, and ultimately with the goal of making it a one and done. Get the report into a place where you're not going to get any errors or formatting issues that can't be uploaded. Pop that in and on you go.
Yeah, it's quite interesting how all this sort of data infrastructure takes on arms and legs in terms. So we all like using more data, but the data has to sit on good infrastructure. And as we get more data, we then have to have the controls around it to make sure it's actually being corrected. I suppose you're being corrected because I'm sitting there thinking about customer detriment. If, for example, and the risk around that, if, for example, people's credit bureaus reporting is wrong, and I suppose just the risk around that, and the fact that the amount of data we use is increased, but then also the risk associated with that kind of increases as well. That's why the premium around getting it right.
Quality of data, particularly in credit reporting, is so important. When we came out to build a real-time credit bureau, we were able to stand the platform up relatively quickly. But what we realized is that the lending market actually needs stepping stones to get to real-time reporting via API. And that's the journey that we're on at a business at the moment. And what Delta represents is that first step in the way of enabling better reporting by improving the quality of data that's going into the system as a whole. So it's a systematic tailwind, as well as giving lenders the easiest pathway into reporting into us.
Yeah, and where do you see that sort of like going? All this data is getting much more real time. I suppose we're in this kind of real time kind of world. Where do you see it going? It feels like we're going to that sort of like real time kind of bureau feed in and out. And I think you've done some work already. I think with Curve, I think it is. So you've done some of that. Is that where you see the future going? Where it's sort of like the customer will have a transaction or something happens on the customer's file, and then that's almost like immediately accessible in terms of the bureau reporting.
Yeah, so real-time reporting with Curve is a fantastic step in the right direction. They join a suite of lenders that are reporting into us in similar fashion. And it's great to see that the pathway from reporting into us via Delta and then transitioning to real-time reporting via API is working. That's fantastic for us. The step towards reporting in real time is one of the most important and beneficial steps any lender can take in ensuring that the credit risk information they receive is of the highest quality and the least delay. Far and large, that will deliver the strongest benefits from a systematic point of view, the faster we can help lenders move towards reporting in real time. And we know that there's different stages that lenders are at in that journey, and we are patient and we're partnered and looking to innovate to deliver that value that they need to get there. But there is no doubt in my mind that this is a multi-billion-pound issue that can be chewed into with the advent of real-time reporting.
I was thinking there just around a bit around triggers, or for example, we do on triggers or flags or whatever it is in terms of like flagging some of those. That's where real time becomes particularly beneficial. I know that's used quite a lot in the collection space. Something has changed, and you can be waiting for 30 days, 45 days to then take action on that. But actually, if you're getting that real time, then it means it's much more applicable. Probably leads to easier conversations with customers as well.
Yeah, correct. There are so many use cases that real-time information into the bureau can be beneficial. And the examples that you just used there, triggers or alerts as we call them, from a customer management perspective, are very valuable. And for alerts, real time doesn't necessarily have to be there. It's really just a webhook notification to a lender saying that the consumer that you've lent to has had a change, either a positive or negative aspect to their credit report reported. Obviously, if that happens in real time, it's much more valuable. You look at credit cards and limit management as an example. The amount of time that we have spent pouring through FOS complaints and learning from upheld cases where the judgment has been made that the lender hasn't had a clear enough picture of the consumer's intra-month lending, the proof is in the pudding there. That is something that is specifically going to be solved with real-time reporting and broader transparency across all of the bureaus. And that is the direction in which the THIMS has ultimately pushed the industry, but we're now pushing for the implementation of that as fast as possible.
Yeah. What about, so a big topic last year was buy now, pay later as an example as well. And that was like sitting on a little bit on the periphery to a certain extent, although it's been kind of brought back in as quick as possible into financial services, the general kind of environment, because that's very real time, right? And what are the implications of that on the financial system, and particularly around visibility, around credit worthiness as well?
Our view on buy now, pay later is it's likely one of the strongest drivers of potential. Our view on buy now, pay later is it's potentially one of the strongest drivers of financial inclusion possible in today's society. The challenges that they face, however, is that it's such a modern credit product that, to use the example previously of taking a modern loan management system and jamming that into a traditional file format for reporting, the quality and value of buy now, pay later data gets lost in that. And that's accelerated by the fact that it's 45 to 60 days late, right? The average Klarna product is paid down 90% of the time before it's actually due. So that delay, you're missing any sort of happening or events in the life cycle of that product. Buy now, pay later needs real-time reporting to deliver full value to the system. And we have countless conversations with lenders who say that there is value in buy now, pay later products being reported, but the transparency and accuracy of buy now, pay later and traditional bureaus just isn't high enough quality to be able to decision off. And so we're in a place with buy now, pay later now where in the next quarter, the regulations will be clear. Your ClearPays, your Klarnas, your Zilches are all on different various stages of getting their FCA licenses, which will be a requirement. And they've all started reporting into bureaus, or most of them have. They'll normally pair with a primary bureau like a TransUnion or an Experian, and they're getting their affordability practices in place and credit risk to an extent. But what will happen is that's all going to flow into the system, and they're going to want more. They're going to mature as lending businesses. They're going to need to be looking at decline rates in closer detail. And at that stage, the demand for real time, we're expecting that to come through.
And I suppose it's just also the intensity of the time frame, as you say, as well, which is, so if it's like a 90-day kind of product where it's being paid off within 90 days, it's just like you have to have that much shorter time frames rather than monthly time frames to really understand the customer situation. And that has impact for the rest of us and elsewhere in the industry as well. It's like understanding that as part of the ecosystem, and speed becomes even more important to a certain extent.
Exactly. Yeah, I think the speed and the flexibility are so valuable for modern credit products. That's where reporting via API really comes into its own. Take Curve as an example. They have a hybrid buy now, pay later product with their Flex product, and it's designed to help consumers build their credit profiles as well as providing flexibility. And that's being reported into us via API to massive benefit to their customers. Someone who takes out a Flex product is in our bureau that day. That will then be credit visible from an identity or a credit risk perspective for any lender that's pulling from our API, whereas that would take 45 days a minimum to appear in another bureau.
I wanted to come back, I suppose. Obviously, you guys are in the market, challenging some of the traditional ways of thinking as well. What are you finding in terms of like sort of reception and I suppose interest in the real time piece?
Yeah, incumbency. It's a fantastic thing to go up against. Apathy in some circumstances. Look, that's a multifaceted question you have here. From a commercial perspective, getting in the door and building a relationship with someone is the first challenge. And let's face it, credit risk managers, along with probably anyone in management and above, just get hammered by sales emails. We try and avoid that. You and I were talking about that earlier, Chris. So we try and avoid that. But once we have a relationship with a lender, it becomes a question of when, not if. The credit risk managers, everyone sees the value of real-time data, and we're going through a process of building our network and transitioning lenders from saying, this is great, we need you to have more lenders reporting into you, to, oh, you have lenders reporting into you, what's the value of the credit products? And now we're at a point where it's coming in, assessing the value of the bureau and reporting into us because you're using our products. And that's a great stage to be at. But for the last 2 years, building credibility with the market came relatively easier than it might be to someone who wasn't in the industry before. Will Mason, as an example, is an exceptionally credible individual in the credit space. He's been there and done that. So the credibility isn't as big a challenge. Where it is just finding that value exchange for getting lenders to engage with us. And that's where the Inclusive Lending Innovation Charter that we've introduced for lenders with a social purpose or looking to serve the financial excluded really comes into its own. Like I said before, the 7.1 million in the UK are currently misrepresented or underserved from the credit system. That's 14% of the adult population. Our mission here is centered around supporting lenders that play that crucial role in ensuring fair and responsible financial services are accessible to those people, regardless of their background.
I mean, it's an interesting sort of journey that you guys have been on, because trust is so important, particularly in the financial services space. But just like how you like layered some of the products in terms of from the affordability to this new Delta product, and you've got the credit bureau product, into like how do you build that across? And I suppose some of it comes down to trust, doesn't it? Making sure you got trust in the market, and then it's like accelerates. And it's a great story in terms of like how you've layered that on and how that's going to transform the market as well.
Exactly. The way that we look at the lending market is broken it into sub-networks of lenders, and that can be cut up in a number of ways. You've got your super prime, prime, near prime, subprime. So you could cut it on the credit risk profile of customers they serve, or you've got credit cards, buy now, pay later, personal loans, banks, motor, secured, all of these different types of products. So you can cut it by that as well. The approach that we've taken is paid special attention to non-bank cards, personal loans, and buy now, pay later. And the exciting point that we're at with the Innovation Charter is that we're now getting to a stage of saturation across the subprime personal lending space. So we've got enough coverage of that market to now be delivering value through our credit risk products, which means that we have affordability, credit risk, and delta that we can offer value for that. One of the most important things around the innovation charter is helping to expand that footprint. We're partnered with fantastic lenders like Moneyline, Fair for You, as well as being supported by other lenders in that space and responsible finance. People like Shona, who are championing us in all of their conversations and looking to make introductions, is invaluable to us. And the next phase of the Innovation Charter is now expanding that and offering Delta to the credit union space.
Yeah. And I see all the bureaus have a fantastic sort of helicopter view around what's going on in the market, what's going on in the lending market in particular. And you mentioned some sectors there. What's your kind of view around appetite for lending, appetite for expanding the book? Are there sort of like areas which you see as being hotspot where people are more keen than others? And has that sort of recovered really from at least some 2 years ago? What's your kind of view on the lending kind of market?
Yeah, the lending market is thriving. Ultimately, if you look at the credit union space as an example, they're up over 5% of the UK population. Over 1.5 million people use credit unions as of a few years ago. I am also a credit union user, have a nice savings pot with London Mutual. Everyone's using, and it's not just the great rates and the personal experience with them, it's the fact that they're building valuable services that they offer their consumers. One of the most important things for us, and one of the roles that credit unions in this subprime place does, is it helps the 3 million people in Great Britain who've borrowed from illegal money lending in the last 3 years actually find a place in the established financial system. And that's where we see our value in supporting that really important function in the market. In working to understand the challenges that they have as businesses, we've identified that fragmented reporting across the three bureaus prohibits visibility between the members' accounts and payment performance, and a lack of innovation in sharing things like positive credit signal that could promote financial inclusion just isn't there. There's no innovation in the bureaus. That, with some other more product-related issues like fraud solutions and networks, are cost prohibitive to the space. These are the specific pain points that we're looking to address with the Innovation Charter.
That's fantastic. So I know you've gone through some pretty exciting announcements in terms of launches, or you got new product launches, those kind of things. And where do you see yourself going for the next sort of 3 years or so? What else is on the horizon, given where you've come from and everything you've done in the last 2 years?
So in terms of the personal loans subnetwork, the most important thing for us is continuing to drive coverage of credit usage. So we will continue to offer Delta free for Innovation Charter members in a bid to help them with multi-bureau reporting, as well as building coverage and accuracy across the space. We think that this will help drive first payment default, which is probably one of the biggest challenges the industry is facing, to a more reasonable number. Our goal is 5%, which is a few percentage points lower than what the industry standard is. We would love to get the market, subprime personal lending market in that place. So that's our goal. On the other side of it, our engagement with larger, higher profile non-bank lenders continues to grow, and we're looking to establish ourselves in that market. Affordability very much has its place across scaled, digital first automated lenders in that end of the market. But now it's how are we transitioning them to using our credit risk and fraud products. So it's very much following the same methodology that we've been doing from day one, but just executing on a later stage of it.
It's exciting times, and I think the one thing, taking a step back, that I have to take away is like we have this sort of like quite legacy kind of infrastructure there, and you guys are in the front around. So like, how do you actually put modern computing data infrastructure really into our financial system to a certain extent, which is something that, I mean, all of us who work in the industry knows it needs to be done. Legacy systems is one of the things that we deal with every day. So it's a fantastic goal, and James, I really appreciate you taking me through it and explaining some of the nuances as well. So it's really appreciated.
No, thanks for your time today, Chris. Thanks for having me on.
You're welcome.